All right, I think we'll get started. As I'm chatting here, if you just want to send me a quick message to make sure that folks who have dialed in can hear us okay. I'll probably just kick it over to Lynn for the director's cut for December 2019 numbers.
Great. Thanks, Katie. The audio is working?
Yep.
Very good. Thanks for showing up for our February director's cut and or tuning in. It's we're talking December production, November, December production, but it is February and it's Valentine's Day. And unfortunately, not a lot of candy and roses in today's report. It's a bit of a downer, so we'll just go with that. We saw about a 3% drop in oil production, down a little over 43,000 barrels a day. Did some analysis on self-curtailment, so we can estimate self-curtailment, and then I checked with a couple of operators to see whether we're in the ballpark. It looks like self-curtailment accounts for more than the entire drop. That in an effort to try to balance gas capture and bring that up, they curtailed about 54,000 barrels a day. And so one of the major operators that I've been talking to has between 20 and 30,000 barrels a day self-curtailed right at this point. When we get to talking about gas capture, I want to talk about how important that has become to all of our operators. And I know that because I got to spend week before last in Houston. It's NAPE week, which is the North American Prospect Expo. And I got to visit about a dozen of the top Bakken operators and talk with their CEOs and hear what their plans are and what the market is telling them and what they're seeing in terms of oil prices and the outlook for 2020 and 2021. So we'll talk about that. Oil prices have taken a serious dive in the last week, and that is almost entirely due to the new coronavirus. I think they're calling it COVID-19 or something like that. Yeah. So there's a major report out today from the Oil and Gas Journal where the EIA evaluated the impacts of the coronavirus, and for the first time in a decade, maybe a little more than a decade, they've actually decreased their quarter-to-quarter demand numbers. So we've had a solid decade of every quarter oil demand going up, and now they're looking at second quarter of 2020 as an actual down number. I think to the tune of like 800,000 barrels a day. And that seems remarkable, but when you think about the amount of goods that go to and from China by ship, and all of those are powered by crude oil, and when you think about the impact on manufacturing and consumers around the world, it's a pretty enormous impact. The best analog we have for this is 17 years ago when the SARS virus hit. It was a similar type situation. That virus outbreak lasted about 5 months, but it impacted oil markets for a full year. And so I think the anticipation is that it could be the end of this year before the impacts that are beginning to peak now work their way out of the oil markets. So we want to stay tuned. About 3 weeks from now, OPEC is going to meet, and they're going to talk about how they're going to respond. They are discussing an additional 600,000 barrel a day cut. I mean, they've already agreed to reduce production from what they think they could produce by 1.7 million barrels a day. They're talking about another 600,000 on top of that in order to compensate for the drop in oil demand as a result of the coronavirus. And so, interestingly enough, they're also reporting about a 123% compliance with that 1.7 million barrel a day cut, which is unusual for OPEC Plus. I mean, usually they're less than 100% compliant with their scheduled cuts, but this time they're taking it super serious, and they've actually reduced production more than their anticipated cuts. But in 3 weeks, first week of March, they're going to meet and talk about their response to COVID-19. So big impact. It's definitely sort of batten down the hatches in the oil and gas industry and even in the North Dakota industry. December gas production down, but about 2/3 of the reduction of what we saw in oil. So again, seeing a gas oil ratio increase. Gas production down about 2%, oil production down about 3%. December inactive well count up significantly. It's up 200, about 10%, a little over 10%. That's pretty normal for wintertime. And I did check, what the weather was like in December out in the oil patch. We had a little over a week of sub-zero temperatures and some fairly windy days, and that really cut into completion activity, and it cuts into workover rig activity, which ends up with inactive wells. Little bit of an uptick in seismic activity. That's all having to do with the future of carbon capture in the state. That's something we're going to want to pay attention to. I know it's not oil and gas directly related, but it is regulated by our oil and gas division. It's also critical to our coal industry. And so we've had some significant seismic activity centered around some of the research that's going into the future projects, Project Tundra, and a potential project up here at Underwood. So we're a little excited about that. Natural gas prices are incredibly weak. They are at the point that they were at close to 40 years ago. I mean, we're talking decades lows in terms of natural gas prices. I had a chance to visit with the Government Finance Committee earlier this week over at the Capitol, and they were asking about the potential for natural gas exports. Pretty much all of the existing potential or the near-term potential is going to be consumed by Appalachian Basin production. It's going to go off the East Coast. The key for North Dakota gas is to find an outlet to the West Coast and to Asia. When I was in Houston, had the opportunity to meet with the regulators from the North Territory of Australia. They regulate what's called the Beetaloo Basin. They have an enormous potential unconventional natural gas play there. So while we're selling our natural gas for less than $1.50, 1,000 cubic feet, they have the potential to get $7 because they can liquefy it off their north coast and send it to Asia. So that would be a key sea change in terms of natural gas for North Dakota. Whether that can happen over the next 5 to 10 years remains to be seen. Before I talk about attitudes and that sort of thing from discussions during NAPE, just very quickly, there's an update in our director's cut on break-even prices. You can see that a couple of counties have moved into the red because of current WTI price of $52 and some better data on IP rates and that sort of thing. Burke and Divide County, no longer economic at this oil price, close, but no longer economic. Other than that, the core counties, McKenzie County, Williams County, even Dunn County, all moved down about $1 because of the performance of the wells in the core area. So great gas production. We're still seeing a lot of impact from gas capture. Still thinking that when the new infrastructure shows up in the data in January, the latest plant to come on, Dimmick's Lake, and the full impacts of the Elk Creek natural gas pipeline, that we're going to get to that 88%. So we'll keep watching that through the spring here, but we think that we can get to the 88%. Some really good progress going on in the research on natural gas storage. Major oil company has signed up to be the partner in the $6 million study. So they've already put together their plan for temporary gas storage in a conventional producing horizon and a gas storage EOR project in the Bakken formation. And they, between now and the 1st of April, are going to finish all of their FEED studies on temporary gas storage in the Broom Creek formation. So that would be the third piece of that puzzle. So visiting with folks in midstream and in the upstream the week of NAPE. Midstream, very, very optimistic. The investment environment, they're seeing a lot of great support from investors, and with the regulations that North Dakota's been modifying, they're seeing profit margins and long-term forecasts that they like. And so on the midstream side, it's full speed ahead. On the upstream side with the operators, they see this year as very much like the last half of 2019. And so as you saw, or as we noted, first half of 2019, we ran in the mid-60s for rig count, and we were well above 100 a month for completions. Second half of 19, we were tapping along at about 100 completions a month and 55 rigs. And that's what they see for all of this year. They're all operating within free cash flow. That's what the markets have told them. So if they're using private equity money, the first question that they're getting asked is, are you operating within free cash flow? We're not going to lend you any money or look for production growth. That's what the boardrooms and the investors of the IOCs are doing the same. The second question they're getting asked is, what does your ESG plan look like? Which is environment, social license, and governance. So in the 2 years since I did this last, I don't get to go during the legislative session, so I go in even numbered years. So 2 years ago, nobody mentioned that. Today, it comes up in every board meeting and every discussion with private capital investors. Number one question, can you continue to operate within free cash flow? Number two question, what does your environment, social license, and governance plan look like? How are you going to deal with the pressures being applied to the oil and gas industry to reduce carbon footprint and to be more efficient? So a real sea change amongst the oil and gas operators in North Dakota. I'll end with one comment from them. They all said, this is a great resource. It is the best place to deploy capital on the North American continent. And so we're going to stay. Nobody was looking to sell. Nobody was looking to get out. Nobody was expressing an exit plan. Everybody was looking around to see if maybe their neighbors wanted to sell a little bit of something to them so they could consolidate their position. And there was a lot of discussion about the core inventory, the core area drilling inventory. And it ranged anywhere from 2 to 5 years amongst oil companies of how long they thought it would take them at today's rig count to drill up their inventory in the core of the Bakken. So that's kind of the window that we're seeing. Now, that doesn't mean we're done drilling in the Bakken. What that means is the best of the best is finished. And maybe with technology improvements, maybe a little oil price improvement, or just kind of continuing to push forward, they'll move out into some of the areas that yield a little lower well productivity. But for the next 2 to 5 years, they have plenty of wells to drill in the high productivity area.
Thank you. Any questions for Lynn?
I've got 2 coronavirus related ones.
Okay.
So first, I know you referenced that prices have been dropping. What would you say are maybe the best figures to look at? Like, I just looked up the UCI up on my computer here, and it looks like a month or so ago we were maybe $7 higher than we are today. Is that a good gauge to go by, or what would you say?
Sure. So the question from the room was, what's the best way to gauge the impact of the coronavirus? And I would agree, looking at WTI futures prices or WTI Oklahoma prices is probably the best gauge of the impact of the coronavirus. Interestingly enough, and I talked about the SARS virus, that year-long impact ranged from $5 to $7 a barrel on oil prices for an entire year when the SARS virus broke out. So it's pretty similar. In fact, it's eerily similar to what's happening with the coronavirus. And I think the efforts of OPEC to try to reduce production to accommodate the reduced world oil demand, it'll moderate that some, but I don't think they're going to be able to make up a $7 a barrel impact on 99 million barrels a day of world oil demand. So, but yeah, that's how we've been tracking the impact is looking at WTI prices.
Okay. And then has the Bakken really experienced any of the effects of those lower prices yet, over the last month or so, or is that something that might be yet to come?
Yeah, so the question was, have those lower prices been built into what we've already seen, or is that impact yet to come? And I would say it's probably yet to come. What is really vulnerable is a lot of our conventional well assets and production, and some of the Bakken wells that are 10 years old now and are stripper wells. So I think we're going to see our inactive well count climb all the way through the middle of the year, as that's probably the primary place that this is going to impact. When we talk to people about their drilling budgets and their completion budgets, they had already kind of factored this in and still felt like they were going to stay in the mid 50s for drilling rigs and stick around 100 to 110 completions a month. The big service companies have scheduled their budgets to run approximately the same number of frac crews as they did in the second half of 19. So they seem to have all factored that in to their 2020 plans. But I think where we will see it is our inactive well count and the low level producers. They're just really marginal. I'm sorry?
They're more marginal.
They're more marginal. So they go from marginally economic to very uneconomic with a $7 price change. But most of the price decks for the people who are actively developing core Bakken assets are mid 40s to mid 50s price decks, and they can continue to do what they want to do in that price range.
Well, I was thought of this. How long does it take to bring a well back into production after it's in inactive status? Do you have an average on that?
Question was, how long does it take to bring a well back into production after it's been in inactive status? And our regulations allow it to stay in that status for a year. The typical workover project can be anywhere from 1 to 2 months in order to return one of those wells to production. So you got to get it on a rig schedule. You got to get the workover rig crew out there, and they perform the work, and then it takes it a while to get back up to production. So it can easily take 2 months, even once you decide to invest the money. And my expectation is at these oil prices, the cash flow to returning inactive wells to production is turned off. And I anticipate that they're going to take full advantage of that 12 months that well can sit in that status.
I do have one question on here related to the gas capture percentage
Oh, yeah.
that had gone up to 84%. And so is there any more detail you can give on timeline or an expectation for getting closer to that 88% goal?
Yeah, so great question. And we're optimistic that we're going to reach that goal with our January production. You know, that's the heart of winter, so maybe not, but we're very optimistic that we'll get there in the first quarter of this year. So that would, you know, maybe take us to the end of March to get there. That's kind of the time in the planning horizon that the Industrial Commission plans to really open up discussions and put out, talk about a draft for a revised gas capture policy. So we're looking at gas capture policy being revised between the 1st of April and the end of September, so that it's in place well ahead of the November 1 deadline where it goes to 91%. But we've been meeting with midstreamers too, last 6 weeks or so, and they're very optimistic that they have built the right infrastructure to get us there. That they have not only built the processing infrastructure, but they've built the compression and gathering infrastructure to get us there. We're still going to have a few hot spots, and there are some areas where there's just delay built in. So for example, north of the Missouri River, everything is kind of waiting on the WBI expansion to take place, and that doesn't happen until the fourth quarter of 21. So this whole phase in of the new gas capture policy could be a year long or it could be less, but we're going to revise the policy in the second and third quarter of this year.
On that note about flaring, can you talk about what your message was to the land board earlier this week when they were, you know, going to send out these letters to companies to pay back gas royalties? And can you also talk about what sort of impact you think companies having to pay back those royalties to the state would have on flaring?
Mm-hmm. Yeah, so the question was the decision by the land board to send out the letters and my conversation with them. And so I shared with them many of the same things that I just shared with you of what the CEOs told us. And my concern that I expressed to them was that being overly aggressive in their efforts would be a disincentive in terms of flaring reduction, because the quickest and easiest way to reduce the royalty burden on gas is to flare it. And so that creates a disincentive if you become too aggressive on royalty calculations and royalty collections. And then the second part was that because I urged them to look at the big picture, the whole pie, and understand that where you really collect a lot of royalties is on oil, and that if this became a disincentive to complete oil wells or drill and complete new wells, then it becomes an overall reduction in royalties to the trust. And you know what I mean by that is you might be looking at a few cents an MCF in royalties on natural gas, but if you extract that from the free cash flow and you end up not drilling one oil well, you could have huge impacts on oil royalty income. So I just was urging them to be cautious and you know, track all of that and the overall full impact, not to take a narrow view that here's the amount of gas and here's the way it ought to be. So
do you worry that the letters that they sent out, sort of this matrix that they came up with, could be too aggressive?
Yeah, the question was, am I worried that it could be too aggressive? And I think the answer to that would be yes. I'm concerned about that. I can say that this potential action was brought up by every one of our operators in Houston as a concern. And so we'll see how they deal with it and whether they're going to propose settlements or what they're going to try to do. But again, like I said, if one gets too aggressive trying to collect a few pennies on natural gas, you could give up dollars on the oil side.
Any other questions about director's cut? Over to Justin.
All right, thanks. Turn it on. So there we go. Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. An update on this first slide that I always pull up, taking a look at regional oil production. And so last month I had made some comments about some data lags that were taking place with Eastern Montana production. That appears here just the last number of weeks since that time frame that has been addressed, and they have now what seems to be caught up with a backlog of production information from that state. And so it's encouraging to see a more reliable trend line and where things are actually at instead of making some guesses and things. So and caught up to 1 month behind us. So that gives us a good sense of what's taking place for the entire U.S. Williston Basin. Again, we share the same transportation network, much of the same infrastructure for gas and crude oil. So it's important that we have the complete picture from a production standpoint. So region-wide, somewhere between, at least today, at 1.55 million barrels per day that needs to be handled regionally. When we take a look at slide 3, again, this is just my update every month of the changes, what we're seeing for oil and natural gas. And so while in both scenarios, not the highest drops in either scenario, but significant. And not surprising given as we head into the winter months, as Lynn alluded to in many of his comments, the cold weather and the challenges associated with that compound on a lot of the comments he had made about pricing. I don't have a crude oil forecast update in this slide deck, but you will see in a moment my natural gas. But I am anticipating fairly flattish, very slight growth as we come through the 2020 season with some continued fluctuation and challenges, especially January and forward as we wrap up winter time. Slide 4, we have seen some changes in the dynamics of how that crude oil is being marketed out of the region. If we just bump forward to slide 5, the big changes, we've seen some shifting between the pipe and rail movements. So the first thing I want to point to is, again, that blue dotted line, that Brent WTI spread. It spiked up a bit in the month of December, over $7 per barrel. Again, I've made comments in the past that 5 to 6 seems to be the threshold of when we see barrels shift which direction they want it to be marketed. And at $7, that certainly pushes the economics in the favor of crude by rail. And we saw that in the numbers. We saw barrels that had that flexibility, that weren't committed to one of the pipeline systems, shift to that mode of transportation. And then in a moment, we'll take a look at some of the destination details. But just the raw numbers, just over 300,000 barrels per day is my rough estimate of where that was at in the month of December. And then the destination, also some interesting dynamics at work here. So we saw that in the month of November, at least, we don't have December data from the EIA. In November, we saw the shift where we saw more barrels headed towards the East Coast as opposed to Pad 5 on the West Coast. The interesting dynamic will be next month when we see some of those estimates for the month of December and how the industry decides to market those barrels. Again, taking a look at Washington legislation and volume limits and all of that taken into consideration. So the December numbers will be interesting. We'll take a look at those next month and see what
what they tell us. For the month of November, again, the latest pricing data set we have for those coastal refining centers, 63.42 on the East Coast, 63.01 on the West Coast. So seeing that shift to the East Coast again, financially, it appears, at least from this data set, again, we don't have any of the proprietary market information, but that again, some of those shifts may be related to the Washington state legislation and wanting to market those barrels in another marketplace as they exit 2019. And then where we sit today, mid-February, that Brent WTI has shrunk, now just over $5 per barrel. So now we're getting back towards that dynamic where we're seeing more and more barrels trying to get onto the pipeline network. So it'll be interesting, again, how that plays out at the end of 2019. But as we enter now into January, February, I'm expecting to see those barrels pull back towards the more traditional pipeline routes out of the region. And then again, record high numbers for what's being reported through the border ports. Again, truck and rail movements, both north and south. Again, still struggling to get a lot of color on exactly what's taking place with that. But again, reporting it as is in its pure form here. But I wish I did have more information for everyone. Again, has a lot of folks scratching their heads a bit. Slide 11, switching gears now to the natural gas side. The one portion of this pie graphic that we saw shrink was at 4%. Last month it was at 5%, which is flaring from wells that are not connected to a gathering system. We saw that shrink, which was encouraging with the gas plants that came online in November, as well as the Elk Creek pipeline system in December. If you would have asked me which piece of the pie was bound to shrink in December, it would have been that blue piece, and that's what we did see. Slide 12, again, no major changes, but just that 1% tick down in the month of December. And then slide 13, this is one I spent a little bit of time last month talking about. This is our pace of getting new wells connected to gas gathering in the region. The one thing you will notice, I commented last month that black line will hopefully and should rebound in the month of December, and we did see a large portion of that. So month of December, as they had more egress for those natural gas liquids, as those gas processing facilities were able to come online at higher capacities, we did see a higher number of wells being able to flow gas and not have to exclusively be flaring like they were in the month of December. And then slide 14, this is a little bit of a shakeup as well. Here in 2020, you're going to see different forecasts from me as far as how they're presented. In the past, you've all been familiar with my case 1 and case 2 scenarios. I now have what I'm calling my base case scenario, a low case scenario, and a high case scenario. So again, for those of you that were upset that this graphic wasn't complicated enough before, I've now added another component to it. So as we look at, again, the black case is my base case that uses the EIA's oil price assumptions. That had a major shift here a few weeks ago or a couple weeks ago when the EIA came out with their 2020 vision of what oil prices would look like in the coming decades. They did shave somewhere between $15 and $18 off of some of their longer term price outlooks. And so that did have a major shift on not only my crude oil, but natural gas long-term vision for the region. Again, not, as Lynn alluded to, the resource in the ground, everything month to month keeps improving our knowledge base there, but it is a price-based play, and the activity is price-driven, and the production follows the activity. So all that said, when we look at slide 14, in agreement certainly with Lynn's comments about, as we come into 2020 here, with where we see the gas capture infrastructure going into place, the new gas plants that'll be coming online, having Elk Creek for some NGL egress, things are positioning themselves much, much better in 2020 for reaching those target goals. And there will be some wintertime challenges, whether it will be the month of January, February, whether we'll have to wait until winter wraps up a bit. But again, things are positioning themselves much, much better for the region and gas capture outlooks. And then slide 15, this is just that updated longer term vision of where I see natural gas production going. So if you would take this graphic versus a month ago, my base case, certainly is suppressed, and that is a result of that crude oil outlook shift downwards. So with that, I'd be glad to answer any questions.
Questions for Justin? Go ahead.
I was just kind of curious, of the wells that are not yet connected to a gathering pipeline, is there an area where that is concentrated, or is that area case by case?
So the question was, of that 4% of the gas that's flared from unconnected locations, how geographically dispersed is that? I would say it's very geographically dispersed. It may be just a single well or two, or just a pad that's waiting for days or weeks down the road until they're able to get connected. So it's very, very transient. If you were to map the flaring in either scenario, very transient, month to month, it's moving around. It makes that very challenging to address.
When looking at the crude by rail to East Coast versus West Coast, and it looked like for the month of November, East Coast is up a little bit higher than the West Coast. I know you kind of alluded to the fact that maybe some of this has to do with that Washington state law. Are there any other reasons that you can think of as to why that would be the case? Or
At this time, so the question was, what other variables might be at play when looking at that shift from pad 5 over to pad 1? Really, the only one that comes to my mind is that Washington state legislation. We didn't, looking at what the prices were in that month of November, nothing stood out where we saw much higher prices on the East Coast that would cause a shift. So pricing was fairly on par with each other on each destination. So I would suspect that was the case.
Okay, and I can't remember off the top of my head, but do you know when that Washington state law started to take effect? Is it the first of this year?
I don't know, I have that off the top of my head. And do you?
Because I was wondering if the movement would maybe be in anticipation of it, or if it's already actually partly in effect.
So it took effect when, if oil volumes increased 10% more than 2018 volumes. So it actually kicked in the first of 2019, but it didn't start to impact rail movements probably until August. In that neighborhood is when they reached the 2018 volumes and would have had to really start watching how much they brought in. And just a little more color, Oregon is looking at something very similar, actually putting a restriction on rail movements through the state of Oregon to anywhere. So, that's, again, a bit of a downer on rail movements to the West Coast.
Is that the legislature? Or is
Yes.
That, okay.
Thank you, Lynn. And so the official, so these are, again, take it for what it is. These are estimates using that EIA data, which is typically estimated. For those of you that are interested, the best resource that I've been able to find is the Washington State Department of Ecology has a reporting system for crude by rail coming into the state of Washington, where they break down North Dakota versus Canadian. And those reports are available on their website. So I think that would be considered the most official source if someone's looking for actual volumes to compare year to year.
Well, at one point, you were talking about maybe a Christmas gift. And having the federal government step in and say, hey, this is going to happen. Well, here's Valentine's Day, and you still don't have any love from the federal government. Are you waiting for fireworks?
I don't have any updated timelines for you, but yeah.
It might be April Fools.
Yeah.
They have till the 20th of April. So
20th of April is the deadline for them to do something?
yes, yeah.
Oh, okay.
They have to issue a decision by the 20th of April. So.
Any other questions for Justin?
I'll comment quickly on a question Amy had about the delay when oil price shifts take place. So that's something that I have watched closely over the years. Typically, when we see a shift in oil price, and when you try to translate it into production in relation to North Dakota, there's typically at least a 3, if not closer to 6 month delay between if we see a major shift up or down. Typically takes about 6 months before we start to see that reflected in actual production for the state.
Can I ask you why that is? And my theory is that companies plan that far in advance, and so it just takes a while.
Yeah, typically even just the standard time, if you take an average how long it takes when a well is spud, when the drilling starts, to when actual physical production is coming to the surface, 6 months is a good average to use. It just takes that long. You know, we can talk about how quick the drilling is and how quickly a completion crew, but for all the steps to come together to get a location drilled and then brought on production, 6 months is a pretty fair average statewide. Okay, well, thank you very much.
All right. Thanks for joining us. The next director's cut is March 17th at 3 p.m.
Yeah, it's just March.